Hello friends, welcome to the channel. Today we are going to discuss about mutual funds. In the intricate tapestry of financial instruments, mutual funds stand as a vibrant thread, weaving together the aspirations of countless investors. It is a pattern of investing where a person can be a billionaire using the power of consistency investment and compounding. Example: a person can earn up to $39,983,274 by investing $360,000 over a period of 30 years, with an annual 17% growth. But what truly lies beneath this alluring facade? Let's embark on a journey to unravel the mysteries of mutual funds. At its core, a mutual fund is a collective investment vehicle. It's essentially a pool of money from numerous investors managed by professionals to buy securities like stocks, bonds, or other assets. Imagine a basket filled with various fruits. A mutual fund is similar, containing a mix of investments. When you invest in a mutual fund, you purchase shares. The value of these shares fluctuates based on the performance of the underlying securities. If the fund's investments perform well, the value of your shares increases, and vice versa. The world of mutual funds is vast and varied. To navigate this complex landscape, understanding different types is crucial. Equity funds. Equity funds, a cornerstone of the investment world, are essentially pooled investments that primarily focus on stocks or equities. Imagine a group of people coming together to invest in a variety of companies. Instead of each individual buying shares separately, they pool their money and a professional fund manager invests it on their behalf. When you invest in an equity fund, you become a shareholder in that fund. The fund manager uses the pooled money to purchase stocks of different companies across various sectors. The fund's performance is directly linked to the performance of these underlying stocks. If the stocks perform well, the value of your investment grows. Conversely, if the stocks underperform, the value of your investment may decline. Equity funds come in various flavors, each catering to different investor profiles and risk appetites. Large cap funds invest in established, large-sized companies with substantial market capitalization. Mid-cap funds focus on medium-sized companies that have growth potential. Small-cap funds invest in smaller companies with higher growth prospects, but also higher-risk multi-cap funds, diversified across large, mid, and small-cap companies. Thematic funds invest in companies operating in specific sectors or themes, such as technology, healthcare, or renewable energy. Index funds track a specific market index, offering low costs and broad diversification. Equity funds offer several advantages. Diversification. Spread your investment across multiple companies, reducing risk. Professional management. Benefit from the expertise of experienced fund managers. Liquidity. Easily buy and sell fund shares. Affordability. Start investing with small amounts. Tax benefits. Some equity funds offer tax advantages. While equity funds offer the potential for higher returns, they also come with risks. Market risk. The value of your investment can fluctuate with market conditions. Fund manager. Risk. The fund's performance depends on the fund manager's skills. Company-specific risk. The performance of individual stocks within the fund can impact overall returns. Equity funds are generally considered suitable for long-term investment horizons. While short-term market fluctuations can occur, historical data suggests that equity markets tend to rise over the long term. Therefore, it's essential to stay invested and avoid impulsive decisions based on short-term market movements. While stocks offer the potential for high returns, they also come with higher risk. Debt funds, on the other hand, provide a more stable investment option. They primarily invest in fixed income securities like government bonds, corporate bonds, and money market instruments. When you invest in a debt fund, your money is pooled with other investors to create a fund. This fund then purchases a variety of debt securities. These securities pay regular interest, which is distributed to investors as income. The value of your investment can fluctuate based on interest rate changes and the creditworthiness of the issuers. Debt funds come in various flavors, each catering to different investment goals and risk profiles. Liquid funds invest in highly liquid instruments like treasury bills and commercial paper, offering easy liquidity, and low-risk, ultra-short-term funds invest in debt securities with maturities of less than 1 year, providing stability and moderate returns. Short-term funds invest in debt securities with maturities ranging from 1 to 3 years, offering slightly higher returns than liquid funds. Income funds invest in debt securities with maturities of 3 to 7 years, aiming to generate regular income. Dynamic bond funds invest in a mix of short, medium, and long-term debt securities, offering flexibility to adjust to changing interest rate environments. Long-term debt funds invest in debt securities with maturities of over 7 years, potentially offering higher returns, but with increased interest rate risk. Gilt funds invest exclusively in government securities, considered relatively safe but offering lower returns compared to corporate bonds. Debt funds offer several advantages. First, they provide a steady income stream through interest payments, which can be really helpful. Second, they are generally considered less risky than equity funds, making them a safer choice for conservative investors. Third, they spread investments across various issuers and maturities, offering diversification. Additionally, most debt funds offer easy redemption options, providing liquidity. And finally, some debt funds come with tax advantages, which can be quite beneficial. While debt funds are generally considered safer than equity funds, they are not without risks. For instance, rising interest rates can negatively impact the value of existing bonds, which is known as interest rate risk. There's also the risk of default by the issuer of the debt security, referred to as credit risk. And in case of market turmoil, selling debt fund units might be difficult at fair prices, which is known as liquidity risk. Debt funds can be an essential component of a well-diversified investment portfolio. They provide stability and regular income, complementing the growth potential of equity funds. By carefully considering your risk tolerance, investment horizon, and financial goals, you can allocate the right proportion of your investments to debt funds. If you're seeking a blend of growth and stability in your investment portfolio, hybrid funds might be the answer. These funds offer a unique approach by investing in a mix of different asset classes, primarily equity and debt. A hybrid fund dynamically allocates investments between stocks and bonds based on its investment objective. This flexibility allows it to adapt to changing market conditions. For instance, during bullish market trends, the fund might increase its exposure to equities, while in bearish markets it could shift towards debt securities. Hybrid funds come in various flavors to cater to different investor profiles. Conservative hybrid funds. These funds allocate a larger portion of their assets to debt, providing a steady income stream with moderate risk. Balanced hybrid funds aim for a balance between growth and income by investing roughly equal proportions in equity and debt. Aggressive hybrid funds. These funds have a higher allocation to equity, offering growth potential but with increased risk. Dynamic asset allocation funds. These funds actively adjust their asset allocation based on market conditions, seeking to optimize returns. Equity savings funds. These funds invest a significant portion in equity, but with a focus on capital preservation and income generation. Hybrid funds offer several advantages. Diversification. Spread your investment across both equity and debt, reducing overall risk. Income generation. Generate regular income through the debt component. Growth potential. Benefit from the growth potential of equities. Flexibility. Adapt to changing market conditions through dynamic asset allocation. Suitability. Suitable for investors seeking a balance between growth and income. While hybrid funds offer diversification, they are not entirely risk-free market risk. Both equity and debt markets can experience fluctuations. Fund manager risk. The performance of the fund depends on the fund manager's decisions. Liquidity risk. In certain market conditions, selling fund units might be difficult. At the helm of a mutual fund is the fund manager, a financial expert tasked with making investment decisions. Their role is pivotal in the fund's performance. A skilled fund manager can navigate market fluctuations, identify promising opportunities, and mitigate risks. However, it's essential to remember that past performance is not indicative of future results. Mutual funds offer several advantages. Diversification. Spreading your investments across various securities reduces risk. Professional management. Leveraging the expertise of experienced fund managers. Liquidity. Easily buying and selling shares. Affordability. Start investing with small amounts. Transparency. Regular disclosure of fund holdings and performance. While mutual funds offer benefits, they also come with inherent risks. Market risk. The value of your investment can fluctuate with market conditions. Fund manager. Risk. The fund's performance is tied to the fund manager's abilities. Expense ratio. Funds charge fees, which can impact returns. Selecting the right mutual fund is crucial for achieving your financial goals. Consider these factors. Investment objective. Define your financial goals. Short-term, long-term, income, growth. Risk tolerance. Assess your comfort level with market fluctuations. Expense ratio. Compare fees across different funds. Diversification. Ensure your portfolio is diversified. Past performance. Analyze the fund's historical performance, but consider it in context. Mutual funds can be a powerful tool for building wealth and achieving your financial aspirations. By understanding the basics, carefully selecting funds, and maintaining a long-term perspective, you can navigate the investment landscape with confidence. Thanks for staying with us. Please subscribe to the channel for more financial tips and advice. See you soon in our upcoming interesting video on finance.